Hey, this is Phil from Next Chapter Team. Today's video is going to focus on 12 decisions, 12 actions to take to help you get to your first $1 million. Before we jump into the review, please take a moment to like, subscribe, and share. Help the channel grow. Now, sit back, relax, and enjoy this video. The first move you have to make, the number one, is create a budget or spending plan. This is going to help you month to month meet your objectives. And those objectives could be paying off bills, saving for an emergency fund, or even investing heavily. So having a monthly spending plan is the number one item. Number two, getting rid of high interest debts. These high interest debts are usually not debts that you can write off unless you're in a business and then it's a business expense. But because you can't write them off, that means you're tying up money, giving away that interest to financial companies or loan companies, right? Instead, we really want you to be in a better position. And number three, put yourself in the position to start investing as early as possible. This is crazy important. So let's do a quick recap. The first three: one, create a spending plan and a budget or a budget. Number two, pay off those high interest debts, especially the ones that you can't write off on your taxes. And then from there, focus on investing. Start investing as early as possible. It is amazing how different of a balance can be by starting 5 years later. Now, number four, diversify those investments. Don't invest all in one thing. Don't invest in all in one category. Have some spread. Spread it out between a couple of sectors, 2, 3, or even 4. Just spread it out and give yourself some safety because not all of the sectors are going to go down at once. So diversifying your investments is critical. So that's number four. The number five action, educate yourself on financial literature. Really lean into financial literature, whether it be books, podcasts, or even some trainings. These things will help you up level your game. They will help you be more consistent. You may even find out some tips that apply directly to you. It's not some of these trainings of the financial literacies are not always just like very high pie in the sky. Sometimes they get down to really good examples that you may relate to, and you might find a strategy that applies directly to you to help you get to your first million. Next up, you got to focus on increasing your pay. So increase your pay, negotiate for better pay. A lot of times a good idea is, especially early in the year, put yourself on a plan to a promotion. Talk to your boss about it. Figure out what is it going to take. Have a discussion. If I do these 3 or 4 things over the span of 6, 7 months, can I put myself in a good position for the promotion cycle to move up to the next level, or even prepare for another role in a different department? Internal growth is a great way to get better pay. Number 7, with this new better pay and your spending plan, live below your means. By living below your means, you free up money to invest and save and live life and enjoy. So live below your means. Do not spend every dollar. Make sure you have some money for savings, and then make sure you have some money for investing, especially after you get out of the high interest debts. After you get out of those high interest debts, it'll be so much easier. Number 8, avoid those impulse purchases. You really should not be buying a car, vehicles, truck on an impulse. Those are big purchases. So avoid impulse purchases because they're going to stop you in the long term for achieving your financial goals. So after you avoid those impulse expenses, focus on that emergency fund. Don't forget about an emergency fund. This is so critical. 1 month, 3 months, or even 6 months. Early on in your debt payoff journey, it may make sense to have about 1 month, give or take, depending on your situation. But you've got to figure out what emergency fund works best for you. And then from there, especially after you're out of those high interest debts, focus on growing out to 3 to 6 months. Now, a good rule of thumb is if you have very stable pay and very stable employment, so very unlikely of getting unemployed, 3 months might be okay. But if you have variable income and it goes up and down every month, every quarter, you might want to move to 6 months. I've even heard of some people who said, you know what, because it's so variable, I could go 3, 6, or even 8 months with a very low salary because I'm highly commission based. They said, you know what, I'm going to have a whole year. And I said, understood. You've got to do what's best for you and your family. Next up, consider investing in real estate. Now, this is very user specific, but I want to call out, when they say investing in real estate, there's a couple avenues you can do there. Of course, there's your primary residency, if you're ready. Again, invest in real estate when you're ready. And if it's not your primary residence, you may want to do a rental, but again, do that when you're ready. You got to make sure you have a good enough amount of principal there that you're making some actual cash per month while you still have a note. And if you don't want to do that, here's the third option that people don't talk about enough, in my opinion, is a REIT, real estate investment trust. You invest it into a real estate investment trust just like you would an ETF or a mutual fund. Now, REITs are different because in the long term, annually or even quarterly in certain cases, they retain profits and they give it back to you in the form of a dividend. Now, so think of it this way. If you've invested $1,000 and their dividend for the year was, say, 7%, in addition to growth of the money that you put in, that's 7% you can reinvest it in to that REIT. And so your balance just grew. And then the year after, it grows even more, and so on. By investing in a REIT, that's a great alternative to actual physical real estate, especially if you're not the type of person who says, I'm handy enough that I want to be a landlord, or I'm hands-on enough to be a landlord, right? You know, there's being handy, but you may have such a busy schedule that being a landlord may be very troublesome for you. So then you end up having to hire a firm, which is okay. But again, that firm is going to charge you like a 10% on just for operating the lease and whatnot, right? And which again is fair market, right? But you got to remember that's eroding at your profit. So it goes back to the very first part when we talked about investing in real estate. It's important to make sure when you invest in real estate, you have a lot of margin in there so you can be profitable early on in the investment years. Now, obviously, when the note's paid off, then of course you're going to be very profitable, right? Because if you have a piece of property that's generating, we'll say 1,000 or even up to like 3,500 per month, and you have no note on it, no mortgage, right? And then you're saying, I'm going to set aside, we'll say 6,000 a year for repairs. You're going to be doing awesome. But if you have no note, right? There's no mortgage, right? So long term, you want to get to that point where there's no mortgage or very low mortgage, and you know you're really receiving a lot of profits per month. With all that fun stuff I just talked about with return on investment from real estate and other such things, you've got to be mindful of taxes along the way. Especially you self-employed individuals, you entrepreneurs, or people doing lots of gig work, or even doing contract work where you're doing 1099. You've got to be mindful of taxes. Taxes can really creep up on you if you do not take care of them. So as you change your salary, as you change your pay, you switch jobs, be mindful of your taxes, of how they're changing, the tax obligations. It's better to be really, really close, like a small tax bill or a small refund, than having a huge tax bill, especially if you haven't saved for it. So to all my 1099 employees, make sure you're paying estimate taxes, both federal and state. Next up, don't be afraid to take calculated risk. Invest wisely, but calculate those risks and go for it. Next up, on top of that, it's important. Number 13, it's important. You've got a network, build out a network of individuals you could talk with and bounce ideas off of. So network and learn from others. And especially when you go into complex things like real estate, it may even be more important to get a good mentor that can help you along the way, give you tips, someone who's very experienced. So again, networking. Now, I want to call it the networking and learning from others. That applies both to professional life and personal life. There's a lot you could attain, a lot of information you could attain through great conversations. Ask someone out to coffee. Have a real conversation. And if you're going to meet with someone really far, obviously do a virtual conversation. But be respectful of their time. Here's a tip. Come prepared. And if you have lots of questions, send them an email or send them a text with a good bit of your questions before. Let them know, hey, I want to talk about these items. That will tell them, hey, they respect my time, and they will appreciate that. And they will try to show prepared. The very last tip along your way to becoming a millionaire, your first million, is make sure you are assessing and adjusting your plan regularly. I recommend to everyone who's on, whether it be a debt payoff or building wealth or even saving for just a big purchase, prepare to do check-ins monthly or quarterly. And these check-ins, do it with someone who's like your accountability person, right? That could be an accountability coach. It could be a life partner. It could be a friend or a family member that you trust that you can have a real conversation with. Have assessment check-ins. Do check-ins of your plan and make sure you have some milestones along the way. Monthly, quarterly is just fine. Don't wait for annually, because you know what's going to happen? In the last 2-3 months of the year, you're going to find yourself scrambling on something versus every month or two, you're pushing a little further ahead. And you'd be surprised. 1 or 2% of progress on big items per month or per quarter can really build up over time. Hope you enjoyed the recap, and more to come. Now, here's a quick recap of the 12 actions you have to take to put yourself to be in the position to make your first million. 1, create a budget or spending plan. and make that sucker monthly. Number 2, pay off that high interest. That's going to kill you. Pay off those high interest debts and then focus on investing. That's number 3, invest as early as possible. Number 4, diversify your investment. Don't sit in all one asset class. Number 5, educate yourself on financial literature. Read a book, podcast, or even take some trainings. Negotiate for better pay. That's number 6. Negotiate and work towards having a better pay. Work with your employer, and if that doesn't work over the long term, find new employment. But you've got to skill up along the way. Live below your means. Number 7, it's always going to help you. Number 8, avoid those impulse purchases. Number 9, focus on having a nice, strong emergency fund because you are going to need it at some point. Number 10, consider investing in real estate. Again, quick call out here. It can be physical real estate, your primary residence. It could be real estate that you have as a rental, or you could even have a real estate investment trust. And then number 11, because we talk about all this fun stuff of real estate, be mindful of those taxes. You've got to be aware of what your tax situation is and pay them so you don't have big, huge penalties. The IRS is dangerous when you piss them off. Next up, do your homework with the financial literacy and don't be afraid to take calculated risk. With all that financial literacy, you are going to start to take some calculated risk, and it'll pay off in the long term. Number 13, network. Learn from others. Learn from others, brainstorm with others, and take action. Those individuals could end up being your accountability partner. And you know what? Number 14, assess and adjust that plan regularly. I'm telling you, monthly and quarterly is the way to go. Do not only adjust your plan annually. That is a recipe for disaster in the long term. Hope you enjoyed the review. So many more to come.
Hey, thanks for staying to the end. This video is brought to you by the Next Chapter team. If you enjoyed the video, please take a moment to hit that like button, drop a comment, subscribe, share with your friends and family. This will help the channel reach out to more individuals just like you. We offer one-on-one coaching where we work with people and small businesses to determine a clear path to achieving their financial goals. This includes things like budgeting to reduce debts, planning for big purchases, and even learning how to build wealth with the tools that you have readily available to you. So please see our link below to schedule a free 30-minute call with our team to talk through coaching and understanding your current financial situation. Also, check out some of our affiliate links below for our high yield savings account. This is a great place to put your money when you're saving up for those big purchases and your emergency fund. Check out some of our videos right here. And please enjoy and see you in the next video.